What do you think we're seeing here as far as the equities sell-off that we've had yesterday here in the U.S. and right now over in Europe?
Well, I mean, there are always a number of factors that will lift stock prices or depress stock prices. I believe that the fundamental reason for weaker stock prices in the last few months has been essentially the recognition by the investment community that global growth is not accelerating but actually slowing down. We have in emerging economies very clearly a slowdown that is occurring, particularly in China, where year over year electricity consumption is down, year over year railway freight traffic is down, exports as reported by China, but not by its trading partners, is still expanding, but has also slowed down. And so we have also Europe, where there is at the present time practically no growth and also a slowdown. And essentially the US, where people say, oh, growth is accelerating on the upside, but that is not validated by the bond market.
Hey, Mark, let me just jump in here. Mark, let me just jump in here and ask you about the IMF's take on this, because they are saying, yes, there's shaky markets, especially what we're seeing in developing markets and in Europe, but that the U.S. strength is going to rescue us all. Plus, you do have Mario Draghi willing to take any step necessary to save that economy from another recession. No?
No. I think, actually, we have fiscal policies that are expansionary in most countries because we still have deficits. And we have essentially monetary policies that are financing the deficits. And I think the principal problem that the current policymakers don't recognize is the fact that the larger the government is, the less growth there will be, the less dynamic the economy will be.
Mark, let me ask you a question about that, because that raises a really interesting issue. It's Barry Ritholtz. You and I know each other from various conferences we've attended together.
Yes.
All the things you've talked about. Yes. All the things you've mentioned, Europe being weak, China slowing down, those things have all been pretty well known for quite a while. So the question I have for you is, why Wednesday and Thursday and Tuesday this week? Couldn't this have happened any time in the past year? In fact, in the U.S., it's been something like 700 days since we've had a 10% correction.
Why now?
Why now as opposed to any time in the past year?
That is a question I'm very sorry I cannot answer. I couldn't answer why the NASDAQ peaked out on March 21st, 2000 and not 6 months earlier or 6 months later. These things you just don't know. But the market is signaling something, and I would listen to the market. The market is no longer telling you that it's a straight upward climb.
Right.
And maybe the Fed can intervene and buy shares. Don't forget that. They can buy
There's
futures.
always that argument, too, Mark. I wanted to ask you, you mentioned China earlier and the things that we don't know, Barry. One thing we don't know is whether China will change its central bank governor. There's a big battle between those who want to take the painful steps to reform the economy structurally versus those who are desperate to boost economic growth. That being an unknown, how much of an effect will it have on U.S. markets if there is a big change in what China does?
Well, I think the big issue concerning China is that if the economy slows down more than they desire, they will also print money. After all, they invented paper. So they'll also go the way that the others have gone, namely competitive devaluations that are destructive to the global economy and to a sound structural economic scenario.
Mark, we know you're Dr. Doom and Gloom here. You think we're heading to QE99, and for those reasons you are a gold bug. But the basic truth is that gold has been selling off as the dollar has been getting stronger, and it continues to pick up ahead of the rate hike. Would you buy into gold now?
Correct. Well, the issue here is when you print money, and this has been observed already by Copernicus and David Hume and Irving Fisher, not all prices rise at the same time equally. You create price increases in one sector of the economy and then in another sector and so forth. And gold had a huge run between 1999 and 2011 and has been correcting. And lately what we had is a huge increase in the price of not all art pieces, but specific artists and in stocks, especially in the US.
Yes.
And so eventually the money will flow out of the inflated asset markets into less inflated. And I would think that, yes, maybe gold drops below $1,000. We all don't know that. We don't know how much money they will print. But I don't think it will stay there. You understand? It's like coffee was at 300 cents a pound. It dropped to 103 cents a pound at year-end 2013. And now it's more than doubled.
Going back up. Copernicus, though, didn't have the option of buying German bunds. Barry?
Why do you want to buy German bunds? They're yielding 80 bips. See, I agree with Mark about that there's the potential, always the potential for inflation. But keep in mind, during the heart of that rally in gold, we saw the dollar lose over 40% of its value. So obviously anything priced in dollars, oil, gold, food, goes up. Now, to borrow someone else's phrase, the dollar is the cleanest shirt in the hamper. The yen go around the world. The yen, the renminbi, the euro. Where else are you going to go?
Mark? Scandinavia?
Yes,
Mark,
I agree with Barry. I agree with Barry. It's hard to believe that the U.S. dollar is the hardest currency. And I don't think it will stay that way. But it is true for the...
Let me ask one more question. You know, Barry and I were talking with Kevin Krim earlier on Twitter, who saw a whole bunch of helicopters practicing their dollar drop hanging over New York for QE99. But in all seriousness, the Fed is wrapping up its bond buying. What makes you think they're going to continue with quantitative easing when we're hearing they're going to raise rates in the middle of 2015?
We'll see. We'll see. And even if they increase interest rates in real terms, and in real terms, I would say, Barry, please consider, since you live in New York, I suppose, your cost of living increases in New York and not what the Bureau of Labor Statistics tells you about what inflation is. And so interest rates will stay negative for a long time and penalize savers. And in my view, as you pointed out, German bonds, they yield now 0.91%. Swiss government bonds yield 0.42%.
Got it.
So if you just measure the bond yield, then I would say, yeah, some stocks are very attractive compared to bonds.